If you're 70 years old and your RRIF is sitting at $700,000 or more, you're not just looking at a comfortable retirement. You're looking at a tax bill that could take more than $300,000 the moment you pass away. Here's the part almost nobody explains clearly. The standard advice sounds simple. Take the minimum withdrawal, leave the rest invested, and enjoy the money. But if that money grows at even 5% a year, your RRIF balance can actually climb while you're pulling income out of it. By your mid-80s, you could owe the Canada Revenue Agency more than you started with, and that entire bill lands on your estate in a single tax year. If you do nothing, the CRA could end up as your biggest beneficiary, taking close to 54% of that final balance in tax. So the instinct kicks in to fight back, pull more money out early, and spend it down before the tax collector gets a bigger share. That instinct is exactly where a lot of retirees get hurt. There's a second trap waiting on the other side of that decision. Pull out too much in a single year, and you don't just pay income tax on it. You can trigger the old age security clawback and hand back money you already qualified for. I've watched this happen to people who did everything right for 40 years and still gave away thousands of dollars they never had to lose. In this video, I'll show you the exact withdrawal number for a $700,000 RRIF that shrinks the tax bill your family will eventually pay without costing you a single dollar of your OAS. And I'll show you why. Pulling out just $30,000 more than that number can turn into one of the most expensive decisions you make this year. The number that matters most in this whole conversation is $95,323. That's the 2026 threshold where the old age security clawback begins. Cross it, and for every extra dollar of income above that line, you lose 15 cents of your OAS. Cross it by enough, and you lose all of it. You might assume this only applies to high-income earners with rental properties or large company pensions. It doesn't. It reaches nearly every retiree with a six-figure RRIF, and once you see why, you won't look at your withdrawal slip the same way again. Most people think of income as whatever hits their bank account to spend. The CRA sees it differently. When it calculates your net income for OAS purposes, it adds up your RRIF withdrawals, your CPP, your OAS itself, and any capital gains from your investments. All of it counts, even money you never planned to spend that year. This isn't a guess. Canada.ca lays out the OAS recovery tax rules in plain terms, and the threshold moves a little most years to keep pace with inflation. In 2026, that line sits at $95,323. And it matters because your entire withdrawal strategy needs to be built around that number, not around the year your RRIF forces you to start taking money out. Say you're 71 with a $700,000 RRIF. Your mandatory minimum withdrawal that year comes to about $36,960 using the government's 5.28% factor. Add an average CPP payment of roughly $925 a month, close to $11,100 a year, and OAS near $8,900 a year at the current rate. Put those three together, and you're already sitting at just under $57,000 of income before you've touched a single voluntary dollar. Ask yourself honestly, when was the last time you added up CPP, OAS, and your RRIF minimum in the same place? Most people never have, because each number arrives from a different source in a different month, and nobody hands you a total. That leaves roughly $38,000 of room before the CRA starts clawing back your old age security. It sounds like a fair amount of space, until you remember property taxes went up again this year, and so did the cost of topping up the car insurance. Retirees don't usually pull extra money out of a RRIF for fun. They do it to live. You spent close to 40 years being the careful saver, the one who maxed out contributions instead of taking the bigger family trip. Now the system taxes that RRIF on the way out, and then claws back a benefit you also earned, almost like being penalized twice for the same discipline. So the obvious response looks like leaving the RRIF alone and only taking the legal minimum. That feels safe. But that choice carries its own hidden cost, and it's bigger than most people expect. Here's why the tax bomb builds in the first place. A RRIF is fully taxable as income in the year you die, unless it rolls over tax-free to a surviving spouse. There's no gentle phase-in. The entire remaining balance gets added to your income for that 1 year, all at once. There's no exemption for size, and no grace period to spread it out, no matter how carefully that money was managed for decades. Think about Arthur, a widower with a $750,000 RRIF. He follows the standard advice and takes only the legal minimum every year. By the time he's 85, thanks to growth of around 5% annually, his RRIF still sits near $680,000, barely smaller than when he turned 71. When he passes away, that $680,000 lands on top of his other income in a single year, and in Ontario, that pushes a large share of it into the top combined tax bracket, above 53%. His estate ends up paying somewhere around $330,000 in tax, money that would otherwise have gone to his kids. Nobody points out the real cost of waiting this long. Keeping money inside a RRIF does grow at tax deferred, which sounds appealing while you're alive, but deferred isn't the same as forgiven. You're not avoiding the tax. You're loading the entire bill onto your final tax return, at the highest rate your estate will ever see, instead of spreading it across years where you get to decide the rate. I call this the bracket leveling strategy. Instead of letting your estate pay 54% later in one shot, you deliberately pay somewhere between 30% and 35% now, spread across several years, while you're still the one deciding how much comes out and when. Picture it in plain numbers. Paying 30% tax on $100,000 today costs you $30,000. Waiting and letting your estate pay 54% on that same $100,000 later costs $54,000 instead. That's a $24,000 difference on every $100,000 you choose to move early. I used to believe the smartest move was always to leave money inside the RRIF as long as the law allowed, because of that tax-deferred growth. I've seen people do this without realizing it, just shifts a bigger bill onto their kids. When I ran the numbers for a client last year, taking a bit more out earlier and paying the tax now saved their kids about $140,000 down the road. None of this means the RRIF rules are unfair, or that anyone designed them to catch you off guard. It just means the rules reward a little planning now over convenience later, and almost nobody gets taught that RRIF withdrawals and old age security interact at all. If you're trying to protect what you've built from being cut nearly in half by the CRA, stick around. This channel is built around the math the banks rarely walk you through. Here's where it gets tricky. Most people who learn about this tax bomb overcorrect. They pull an extra $100,000 out in a single year to get ahead of it, and hand thousands of that same money straight back through the OAS clawback without meaning to. Getting the number right matters just as much as deciding to act in the first place. Financial planners in Canada are generally trained to plan retirement income out to around age 95. If you're 70 today, that's roughly a 25-year window your money needs to cover, longer than most people picture when they first retire. That window matters because it changes how aggressively you should be thinking about tax now, not just how much income you'll need each year. Go back to 2008, during the financial crisis. Retirees who had money spread across TFSAs and regular non-registered accounts, not just locked inside a RRIF, could pull cash to live on without pushing themselves into a higher tax bracket while their portfolios were down. Retirees who had almost everything inside registered accounts had far fewer good options that year. Think about what that meant in practical terms. A retiree drawing from a TFSA could still cover the mortgage payment and the hydro bill that year without reporting an extra dollar of taxable income, while a retiree relying only on RRIF withdrawals had no choice but to keep pulling money out of investments that had just dropped in value. Moving money out of a RRIF and into a TFSA doesn't change your net worth on paper. It's the same dollars, just sitting in a different account. What changes is how those dollars behave going forward. Growth inside a TFSA is never taxed again, not for you and not for whoever inherits it. The trade-off is straightforward, even if it doesn't feel that way in the moment. You pay tax today, at a rate you can see and calculate in advance, to avoid an unknown tax rate down the road, one that could easily be higher once your RRIF has kept compounding for another decade. It's a trade most people never think to make until someone points it out to them. Ask yourself which feels worse. Writing a smaller check to the CRA this year, on your own terms, or leaving your family to sort out a much larger one later, with no say in the timing. All of this gets more complicated if you're on your own. Couples have a tool called income splitting that softens a lot of this. If you're single or widowed, that tool disappears, and the math turns firmly against you in a way most standard advice never mentions, or plans for properly. Linda is a widow with an $800,000 RRIF. Because she's on her own, she can't split RRIF income with a spouse to keep both of their tax brackets lower, the way a couple could. Couples can also split eligible pension income on their tax returns, which often keeps both spouses' incomes lower and further from the clawback threshold. Linda doesn't have that option at all, which means every extra dollar she withdraws lands entirely on her own return, with nowhere to shift it. Say Linda decides to melt down her RRIF faster and pulls an extra $40,000 out in 1 year. Her total income for that year climbs to $110,000. At that income level in Ontario, she's paying somewhere around 43% in combined federal and provincial tax on that extra chunk. Then, because her income now sits well past the $95,323 threshold, she also loses about $2,201 of her OAS to the clawback. For comparison, a couple splitting that same $40,000 withdrawal evenly might each show only $20,000 of extra income, keeping both of them comfortably under their own thresholds. Add the tax and the clawback together, and her real cost on that extra $40,000 creeps close to 50 cents on every dollar. She keeps a little more than half. That's the number the standard melt-it-down advice never puts in front of people before they act. Here's what actually works for someone in Linda's position. She uses what I'd call the OAS cap method. She adds up her RRIF minimum, her CPP, and her OAS, then withdraws only enough extra to bring her total income right up to $95,323 and stops there. The surplus she pulls goes first into her TFSA, up to the $7,000 of room available for 2026, and anything left over moves into a plain non-registered account instead of sitting exposed inside the RRIF. None of this makes Linda careless with money. She's simply the one deciding where each dollar goes instead of leaving that decision to a default withdrawal schedule. This isn't about depriving herself. It's about timing the withdrawal so the mortgage stays covered, the hydro bill gets paid, and the property tax bill doesn't force a bigger withdrawal than planned, without an extra $2,201 quietly disappearing back to Ottawa. Which raises a fair question. Is it ever actually worth losing some OAS on purpose to shrink the estate tax faster? Sometimes it is. It depends on one calculation almost nobody runs before they decide. And it's worth running before your next withdrawal request goes in. Not after the money has already left the account, and the tax bill and the OAS clawback are both already locked in. Here's the psychological wall almost everyone hits. It's called loss aversion, and it means we feel the sting of handing over $10,000 in tax this year far more sharply than we feel the benefit of our kids keeping an extra $100,000 20 years from now, even though the second number is 10 times bigger. This isn't a character flaw. It's simply how the brain is wired to weigh a certain loss against an uncertain future gain, and it works against you here in a very specific, calculable way. That reaction makes sense. You've spent decades trying to get a tax refund every spring, not writing the CRA a bigger check on purpose. Choosing to pay more tax now, voluntarily, goes against everything that felt like winning for most of your working life. Try shifting how you frame it. You're not paying extra tax. You're buying a tax-free future, both for yourself and for whoever inherits what's left. Every dollar you move into a TFSA today is a dollar that never gets taxed again, not next year, not in 20 years, not after you're gone. That's not a small technical detail. It's the difference between your family inheriting the full value of your savings or inheriting whatever's left once the CRA takes its share on your final return. I remember sitting with a couple who heard all of this and still refused to touch their RRIF beyond the legal minimum. 5 years later, the husband passed away. Her income barely changed, but her tax credits were cut roughly in half once she filed as a single person, and the tax bill that followed genuinely devastated her, both financially and emotionally. None of this is about being careless with money. Linda, Arthur, and that couple all made a reasonable choice with the information they had at the time. The rules around RRIFs and old age security are genuinely confusing, and almost nobody explains how they interact until it's too late to change course easily. So if the psychology is the hard part, what does the actual plan look like on paper? Here are the 3 steps worth running with your own numbers, laid out in the order that actually works, starting with the number itself. Start by adding up your base income for the year. That's your CPP, your OAS, your RRIF minimum withdrawal, and any pension income, all added together in one place. Run this calculation every year, not just once, because your RRIF minimum climbs as you age, and so does the room you have left. Write the number down instead of estimating from memory, since being off by even a few $1,000s can change your safe zone. Subtract that total from $95,323. Whatever's left is your OAS safe zone, the amount of extra room you have before the clawback starts eating into your old age security. Withdraw that safe zone amount as extra income from your RRIF on top of your minimum, and move it somewhere that works harder for your family. A TFSA first, then a non-registered account once your TFSA room runs out. Say your safe zone works out to $20,000 a year. Do that consistently for 10 years, and you've shifted $200,000 out of a RRIF that would eventually get taxed at 54% when you die, and into accounts taxed at 0%, or at much lower capital gains rates in the meantime. If your TFSA room is already maxed out, the same logic still applies inside a plain non-registered account, just with capital gains rates instead of a tax-free result. Done consistently, this one habit can add 6 figures back to what your family actually keeps. But before you touch a single dollar, there's one more thing worth checking, and it's the part most people skip. A large RRIF isn't a problem. It's the result of decades of good decisions. But without a plan, it turns into a tax liability that lands on the people you care about most, all at once, in a single year. Use $95,323 as your guide, not as a ceiling to fear. Stay just under it each year with your combined income, and you can steadily shrink what the CRA eventually collects, without giving up a single dollar of the OAS you already qualified for. None of this requires guessing or hoping tax law changes in your favor. It just requires knowing this year's threshold, checking it against your own income, and adjusting your withdrawal before the calendar year ends rather than after. Planning this way isn't unpatriotic, and it isn't greedy. You're simply choosing when the tax gets paid, instead of leaving that decision to whoever settles your estate after you're gone. The families who come out ahead aren't the ones with the biggest RRIF. They're the ones who understood how the pieces fit together early enough to act on them. If you want to see how this same math plays out for a $1 million RRIF versus a $300,000 one, that's covered in another video on this channel. Worth a look before you settle on your withdrawal number for the year. Subscribe if you'd like the updated thresholds each time they shift. Retirement was never really about how much you made. It's about how much your family actually gets to keep.